There's a pattern playing out right now that happened 3 times before. In 1929, right before the greatest crash in American history. In 2000, right before the dot-com bubble vaporized 78% of the Nasdaq. And in 2008, right before the global financial system nearly ended. Each time, 7 specific warning signs appeared in the exact same sequence. And each time, the experts said everything was fine. The Fed said the economy was strong. Wall Street said stocks were fairly valued. The media said there was nothing to worry about. And the market fell off a cliff. 90% gone in 1929, 78% gone in 2000, 57% gone in 2008, trillions in wealth evaporated, retirements destroyed, lives ruined. And here's what should terrify you. All 7 warning signs are flashing right now. Not some of them. Not most of them. All 7. The exact same sequence that preceded the 3 worst crashes in modern history is happening again in 2025. But this time, there's something different. This time the numbers are worse. The debt is higher. The valuations are more extreme. The leverage is more insane. And the people who are supposed to protect you, the Federal Reserve, the Treasury, the regulators, they're not trying to prevent the crash. They're engineering it. Because that's what they always do. Market crashes aren't accidents. They're not random events. They're controlled demolitions. Wealth transfers disguised as economic catastrophes. And the playbook is always the same. 7 warning signs. Every single time. Let me show you what they are, why they matter, and why every single one of them is screaming danger right now. Let's start with the crash everyone thinks they understand, but actually don't. 1929. The conventional story goes like this. The stock market got too high, people were speculating it was too much margin debt, and eventually it collapsed. Simple. Except that's not what happened. What actually happened is far more deliberate and far more sinister. By 1928, the Federal Reserve knew the stock market was overheating. They could see the margin debt exploding. They watched as brokers lent money to anyone with a pulse, so they could buy stocks at 10-to-1 leverage. The data was right in front of them. And they did nothing. For over a year, they did absolutely nothing. Then, in August 1929, they did something. They raised interest rates. Not gradually, not with warning. They jacked rates from 5% to 6% overnight. This was the trigger, not the cause, the trigger. The market had been running on borrowed money. Margin debt had reached 3% of GDP. That's astronomical. When the Fed raised rates, the cost of that debt spiked. Brokers started making margin calls. Investors who were leveraged 10-to-1 couldn't meet the calls. They had to sell, and when they sold, prices dropped, which triggered more margin calls, which forced more selling. By October 29th, Black Tuesday, 16 million shares traded in a single day. The Dow lost 12%. By 1932, the market was down 89% from its peak. $14 billion in wealth, gone. But here's what they don't teach you in school. The Federal Reserve saw this coming. They had all the data. They knew what raising rates would do to a leveraged market, and they did it anyway. Why? Because crashes don't hurt everyone. They hurt the leveraged. They hurt the speculators. They hurt the middle class who bought at the top. But the institutions with cash? They buy everything for pennies on the dollar. JP Morgan, Rockefeller, the banking families. They bought America for cheap in 1930 while everyone else was bankrupt. Fast forward to 2000, the dot-com bubble. Everyone remembers the insanity. Companies with zero revenue trading at billion-dollar valuations. Day traders quitting their jobs to trade stocks. Alan Greenspan warning about irrational exuberance in 1996, and then doing nothing about it for 4 more years. The Nasdaq hit 5,132 in March 2000. Price-to-earnings ratios were over 200 for tech stocks. Some companies had infinite PE ratios because they had no earnings. And once again, the Federal Reserve had been raising interest rates. From 1999 to 2000, they hiked 6 times, from 4.75% to 6.5%. And once again, they knew what this would do. Higher rates mean higher borrowing costs. Companies burning cash can't raise capital as easily. Investors demand actual profits instead of growth stories. The bubble pops. By October 2002, the Nasdaq was at 1,108, down 78%. $8 trillion in market cap, erased. retirement accounts destroyed. And who bought at the bottom? The same institutions with cash. The same banks. The same insiders who sold at the top. Are you seeing the pattern yet? Now 2008, the housing bubble. This one's even more egregious because the Federal Reserve didn't just ignore the warning signs, they created them. From 2001 to 2004, the Fed kept interest rates at 1%. 1% for 3 years. This flooded the system with cheap money. Banks lent to anyone. Subprime mortgages with zero documentation. Adjustable rate mortgages that would reset to unaffordable levels. Synthetic CDOs packaging toxic loans. And the Fed, led by Alan Greenspan and then Ben Bernanke, said everything was fine. Housing prices can't go down, they said. The system is stable, they said. Then, in 2004, they started raising rates. 17 consecutive rate hikes. From 1% to 5.25% by 2006. And guess what happened? Adjustable rate mortgages reset. Homeowners couldn't afford payments. Foreclosures spiked. Housing prices collapsed. The securities backed by those mortgages became worthless. Bear Stearns collapsed in March 2008. Lehman Brothers filed for bankruptcy in September. The entire global financial system nearly ended. The Dow fell 54%. But again, who benefited? The banks got bailed out. JP Morgan bought Bear Stearns for $2 a share with Federal Reserve financing. The insiders bought assets for nothing while the middle class lost everything. 3 crashes. 3 times the Federal Reserve raised rates into a bubble. 3 times they had all the data showing the system was fragile. 3 times they pulled the trigger anyway. This isn't incompetence. This is the playbook. And it's happening again right now. So what's the mechanism? How does this actually work? Why do central banks engineer crashes instead of preventing them? The answer is brutal and simple. Debt jubilee without forgiveness. Let me explain. The modern financial system runs on debt. Governments borrow. Corporations borrow. Individuals borrow. And all of that debt generates interest payments that flow to creditors. But here's the problem. Debt grows exponentially while economic growth doesn't. Eventually, the debt becomes mathematically unpayable. You hit a point where the interest payments alone consume too much of the economy. Productivity stalls. Growth stops. The system locks up. Historically, when this happened, societies declared debt jubilee. They forgave debts. They reset the system. Ancient Babylon did this every few decades. It's written in the Code Hammurabi. Debts forgiven, slaves freed, clean slate. But modern central banks can't do that. Why? Because the creditors own the central banks. The Federal Reserve isn't a government agency. It's a consortium of private banks. The Bank of England, same thing. The European Central Bank, same structure. These institutions exist to protect creditor interests. So instead of forgiving debt, they engineer crashes. They create controlled demolitions that wipe out debtors while preserving creditor claims. The debt doesn't go away. It gets transferred. Foreclosed homes go to banks. Bankrupt companies get bought by competitors. Failed pensions get bailed out with public money that future generations will pay back with interest. It's a wealth transfer. Always has been. And the mechanism is always the same. Inflate a bubble with cheap credit, let it get massive, then tighten credit and watch it implode. The people who borrowed at the top lose everything. The people with cash at the bottom buy everything. Rinse and repeat. And here's the part that should make your blood boil. The 7 warning signs that appear before every crash aren't predictive. They're operational. They're not signs that a crash might happen. They're confirmation that the controlled demolition is already underway. You won't believe what the first warning sign reveals about where we are right now. Warning sign number 1. The yield curve inverts. This is the most reliable predictor of recessions and market crashes in modern history. It has preceded every single U.S. recession since 1955. Every single one. No false signals, 0. Here's what it means. Normally, long-term bonds pay higher interest rates than short-term bonds. That makes sense. If you're lending money for 10 years instead of 3 months, you want more compensation for the risk and the time. That's a normal yield curve. It slopes upward, but sometimes the curve inverts. Short-term rates go higher than long-term rates. This happens when the Federal Reserve raises short-term interest rates aggressively while long-term rates stay flat or fall. Why does this matter? because it means bond investors expect the economy to get worse, not better. They're willing to lock in lower rates for longer periods because they think rates will be even lower in the future. That only happens if they expect a recession. And they're usually right. In December 2005, the yield curve inverted. 22 months later, the 2008 financial crisis began. In February 2000, the yield curve inverted. 24 months later, the dot-com crash was in full swing. In 1989, the yield curve inverted. 16 months later, the recession hit. The pattern is perfect. And guess what? In 2022, the yield curve inverted again. For over 700 days. That's longer than any inversion since the Great Depression. And in 2024, it uninverted. That's the final signal. Historically, when the curve uninverts after a long inversion, the crash follows within months. We're in that window right now. Warning sign number 2. Margin debt explodes. This is leverage. Pure and simple, margin debt is money borrowed to buy stocks. When investors are confident, they borrow more. When they're terrified, they pay it down. Before 1929, margin debt hit 3% of GDP. Speculators were buying stocks with 10-to-1 leverage. $10,000 in cash could control $100,000 in stocks. When prices fell 10%, you were wiped out. That's what caused Black Tuesday. Forced liquidation cascades. Before 2000, margin debt spiked to record levels. Everyone was borrowing to buy tech stocks. Day traders using margin accounts to flip IPOs. When the crash came, margin calls forced selling, which dropped prices, which triggered more margin calls. Death spiral. Before 2008, margin debt hit new records again. Everyone borrowing to buy real estate and mortgage-backed securities. When those assets fell, margin calls hit, forced selling began, and the spiral started. And today, margin debt is at $1.6 trillion. That's a 33% increase from last year. It's higher than 2000, higher than 2007. The leverage in the system is insane. And when the market turns, when prices start falling, the margin calls will be biblical. Forced selling on a scale we've never seen. Warning sign number 3. Extreme valuations. This is the Buffett indicator on steroids. The Buffett indicator measures total stock market capitalization against GDP. It tells you if stocks are cheap or expensive relative to the actual economy. Warren Buffett has said that when this ratio gets above 120%, stocks are overvalued and dangerous. Above 140%, it's a bubble. Right now, in 2025, that ratio is at 220.8%. Let me repeat that. 220.8%. The stock market is worth more than twice the size of the entire US economy. That's not growth. That's delusion. Every time this indicator has exceeded 200%, the market has crashed. Without exception. In 2000, it hit 145% and crashed. In 2007, it hit 105% and crashed. Right now, it's at 220, the most overvalued market in recorded history. And it's not just the Buffett indicator. The Shiller cap ratio, which measures price to earnings adjusted for inflation over 10 years, is at 36. The historical average is 17. Anything above 30 has always preceded a major crash. We're at 36. Forward PE ratios on the S&P 500 are at 23. That's expensive. And here's the kicker. All of this valuation is concentrated in 7 stocks. The Magnificent Seven: Apple, Microsoft, Google, Amazon, Meta, Nvidia, Tesla. These 7 companies make up over 30% of the S&P 500's market cap. If they fall, the entire index collapses. That's not diversification. That's systemic risk. Warning sign number 4. VIX complacency. The VIX is the volatility index. It measures how much investors are paying for downside protection. When the VIX is high, above 30, investors are scared. They're buying insurance. They're hedging. When the VIX is low, below 15, investors are complacent. They think nothing bad can happen. And that's when bad things happen. Before the 2007 crash, the VIX was below 13.5 for months. Everyone was calm. No one was hedging. Then September 2008 hit and the VIX exploded to 80. Before the 2020 COVID crash, the VIX was hovering around 13 in February. By mid-March, it hit 82. Right now, the VIX has been suppressed. It's been hovering in the teens for extended periods. Why? Because hedge funds and institutions are shorting volatility. They're betting that volatility stays low. They're selling insurance instead of buying it. And as of August 2025, net short VIX positions hit 92,786 contracts. That's a record. Institutions are massively short volatility. And the total assets in short volatility products have grown to $64 billion. That's 30 times higher than in 2018. This is a ticking bomb. When volatility spikes, and it will, all of those short positions will have to be covered. That means buying volatility, which pushes the VIX higher, which triggers more forced buying. It's a feedback loop. In February 2018, this exact dynamic caused the VIX to surge 115% in a single day. Short volatility ETFs collapsed. Billions were wiped out. That was with $2 billion in assets. Now we have $64 billion. The explosion will be catastrophic. Warning sign number 5. Federal Reserve tightening and liquidity draining. This is the kill shot. Every crash is preceded by the Fed pulling liquidity out of the system. In 1929, they raised rates in August. In 2000, they raised rates 6 times from 1999 to 2000. In 2007, they raised rates 17 times from 2004 to 2006. And today? They've been running quantitative tightening since 2022. They're draining reserves from the banking system. They're letting their balance sheet shrink. They're pulling billions in liquidity out of financial markets every month. This matters because modern markets run on liquidity. Stocks don't go up because companies are profitable. They go up because there's cash flowing into the system buying them. When the Fed prints money, that cash has to go somewhere. It goes into stocks, real estate, crypto. Asset prices inflate. But when the Fed reverses course, when they stop printing and start draining, the cash flow stops. Asset prices fall. And here's the brutal part. The Fed knows this. They have the data. They can see the liquidity metrics in real time. They know exactly what they're doing. This isn't incompetence. This is policy. Warning sign number 6. Credit spreads widen. Credit spreads measure the difference between safe government bonds and risky corporate bonds. When spreads are tight, investors aren't worried. They're lending to risky companies at low rates. When spreads widen, investors are demanding higher rates to compensate for risk. That means they expect defaults. Before 2008, credit spreads started widening in mid-2007, long before the stock market crashed. Some hedge funds blew up. Bear Stearns had 2 funds collapse in June 2007. That was the canary in the coal mine. The stock market didn't crash until September 2008, 15 months later. Credit markets always lead equity markets. They see the trouble first. Right now, in late 2024 and 2025, we've seen regional bank failures. Silicon Valley Bank in March 2023. That was a warning. The rapid rise in interest rates broke something. Banks holding long-duration bonds saw those bonds lose value. Depositors panicked. Runs began. The Fed had to step in with emergency lending. That's a crack in the system. And cracks spread. We're also seeing stress in commercial real estate. Office buildings have high vacancy rates post-COVID and high debt. Those loans are going to default. When they do, it will hit banks. And when banks get hit, they pull back lending. That tightens credit, which slows the economy, which causes more defaults. It's a doom loop. Warning sign number 7. Market breadth collapses. This is a technical signal, but it's critical. Market breadth measures how many stocks are participating in a rally. When breadth is strong, most stocks are going up. When breadth is weak, only a few stocks are rising while the majority are flat or falling. Before every major crash, breadth collapses. In 2000, breadth started deteriorating in 1999. Tech stocks kept going up, but everything else was rolling over. In 2007, breadth weakened throughout the year. Financial stocks were collapsing, but the index kept rising because a handful of large-cap stocks held it up. Today, breadth is terrible. The S&P 500 keeps hitting new highs, but it's being dragged up by 7 stocks. The Magnificent 7. Take them out and the index is flat or down. Small-cap stocks are getting destroyed. The Russell 2000 is underperforming. International markets are underperforming. It's all being held up by 7 mega-cap tech stocks. That's not a healthy market. That's a market on the edge. And when those 7 stocks finally roll over, there's nothing underneath to catch the fall. 7 warning signs, all flashing red. The yield curve inverted and uninverted. Margin debt at record highs, valuations at 220% of GDP, VIX complacency with record short positions. Fed tightening and draining liquidity. Credit spreads starting to widen, market breadth collapsing. This is the pattern. The exact same pattern that preceded 1929, 2000, and 2008, and it's all happening right now. So what happens next? History gives us the script. The crash doesn't happen slowly. It happens fast. One day, something breaks. Maybe it's a bank. Maybe it's a hedge fund. Maybe it's a geopolitical event. Doesn't matter what the trigger is. The system is already fragile. All it takes is one shock and the dominoes fall. Margin calls hit. Forced selling begins. The VIX explodes. Short volatility positions blow up. More forced selling. Credit spreads widen. Banks pull back. Liquidity vanishes. And the market falls 10% in a week. Then 20%. Then 30%. The people who were leveraged get wiped out. The people who were complacent lose half their retirement accounts. The institutions with cash wait for the bottom and then buy everything. This is the cycle. It's happened over and over for 100 years. And it's about to happen again. But this time, the stakes are higher. The debt is bigger. 36 trillion in government debt. The leverage is more extreme. The system is more interconnected. When this crash comes, it won't just be stocks. It will be bonds, real estate, crypto, everything. A full deleveraging event, and the Federal Reserve will step in. They'll cut rates to zero. They'll print trillions. They'll bail out banks. But they won't bail you out. Your 401k will still be down 40%. Your home equity will still be gone. And the insiders will buy the pieces for pennies. The lesson here isn't that crashes are unpredictable. It's that they're deliberate. The 7 warning signs aren't accidents. They're operational markers. Proof that the controlled demolition is underway. So the question isn't whether we're heading for a crash. We are. The question is, are you prepared? Or are you going to be the one they liquidate? If this opened your eyes, if you see the pattern now, hit subscribe. Because when the crash comes, and it's coming, you'll want to understand exactly why and who benefits. The answers aren't hiding in the future. They're written in the past. And I'll show you where to look. Are we wiser now, or just walking the same path in better suits? Click the next video for another intriguing narrative. Thanks for watching.